Your portfolio is bleeding, and every time you log in, it feels like the floor is giving way beneath you. Let's look at the numbers. The VN index closed at 1866, decisively breaking the critical support level of 1913. At this level, sellers dictate the terms, and momentum pushes heavily downward. To regain control, buyers must carve a path back up and cross the 1925 mark. Ignoring these exact numbers and trying to outsmart a seller-controlled environment is exactly how retail accounts get wiped out. When the screen flashes red, your instincts pull you in two opposite directions: panic sell everything to stop the pain, or blindly buy the dip hoping for a quick rebound. Listening to generalized market advice right now is useless. A massive drop is a generational discount for one investor and a margin call for another. Your next move isn't based on where the market is going. It depends entirely on your capital structure. Are you trading on margin, or are you sitting on cash? Survival requires you to align your actions with your actual financial position, rather than guessing where the bottom might be. If you are an active trader holding margin positions with the index stuck at 1866, you are in the danger zone. Leverage amplifies downward momentum. Holding borrowed money during a confirmed market slide puts intense, compounding pressure on your core capital until it snaps. You must halt all new margin deals immediately. Your priority is to aggressively reduce your account's margin ratio back to a safe baseline. This chart shows your immediate action plan. If a portfolio stock violates its support level, execute your stop loss, no exceptions. For example, if PLX hits a 6.04% loss or GVR of 4.97% drop, those positions must be liquidated. Locking in a loss hurts. It is incredibly difficult to push the sell button instead of hoping for a bounce. But accepting a controlled 5% hit right now buys you the one thing you need most: capital survival for the next bull cycle. Once you've secured your capital, you need a plan for the cash you have left while the market stabilizes. Catching a falling knife by buying deeply discounted stocks without a confirmed shift in momentum exposes you to further downside risk. This matrix outlines the wait to cross protocol. Instead of buying blindly at current lows, set specific upward price alerts to confirm the trend has reversed. For example, ACB's current price is $23,550. You stand outside until it crosses $23,950. The gap is even larger for HPG. At $24,100, stay away until it breaks $27,550. The trade-off here is straightforward. By waiting for these confirmations, you will miss buying the absolute bottom of the dip. You are sacrificing the maximum theoretical yield to ensure you are buying into a high-probability, safe upward trend. If you are in the second group, sitting on heavy cash reserves with plenty of time, your strategy looks entirely different. This is the Noi-Combe-Taxon strategy. It operates on a 5 to 20-year horizon designed for accumulating wealth over decades. This strategy only works under one absolute condition: you deploy 100% cash and use zero leverage. Your target assets are thoroughly researched mega-cap stocks that are currently trading at distressed valuations because of the broader market panic. With a long-term horizon and cash ready, you focus your accumulation on deeply vetted tickers like VIC, VHM, and GEX. The psychological cost is that you must tolerate seeing your portfolio in the red for months as the market chops around the bottom. Structurally, your capital will be locked up for extended periods, and you won't see any immediate yield. But without the ticking clock of margin interest, a seller-controlled market stops being a threat and becomes a rare accumulation event. Right now, we are in a deeply defensive market. You cannot fight a close of 1866 with borrowed money. Let's look at the scorecard. Your path forward is binary. If you have margin, do not attempt to revenge trade to win back what you just lost. Halt your deals, cut your ratio, and hit your stop losses. A win for active traders today is strict capital preservation and setting disciplined price alerts. If you have cash, a win is methodical, unleveraged accumulation. You set breakout alerts, buy for a 10-year hold, and stay entirely away from margin. As soon as this video ends, log into your brokerage account, review your holdings, and execute any tripped stop losses before the opening bell tomorrow. Surviving this drop isn't about perfectly predicting the bottom. It's about executing unemotional risk management while the sellers are still in control.